Michael, welcome to F.A.C.E. Looking forward to us having a discussion. This is Michael's first time here on the F.A.C.E. show, and waiting to hear from you, buddy.
Dale, thank you for having me. It's a pleasure.
Great to have you, Michael. So, you know what, are you going to be sharing the screen today, showing any charts or anything like that, or do you want me to move around the board?
If you don't mind helping me out there, that would be terrific.
Okay. All right. So I'll be sharing my screen. Michael, I went to your video that you recommended I take a look at before we went to our interview today, but I'm always interested in how people end up doing what they're doing. So was it in college that you knew you were interested in the financial markets and reading the tea leaves of the economy? And what were you doing before you got in the industry, and what was your first gig in the industry?
Sure. So it probably does start in college. I was I originally came into Notre Dame in the School of Arts and Letters, so more liberal artsy, and Notre Dame's a big football school, and I'd go to the football games, and one of the first things that I did was start trying to sell cigars to tailgaters at the football games, and by the hour, that was probably my best job ever. And so I quickly figured that I wanted to study business instead of arts and letters. So I went on to study finance. I got really lucky. I ended up getting an internship at T. Rowe Price as a sophomore in college. So that was terrific exposure to the markets, and I was sort of lucky to get a good name on my pedigree. And I was, able to leverage that into some other roles on the buy side. I worked at a private equity firm the following year, and after college, I ended up at a hedge fund called Broad Run Investment Management. Again, really lucky to have such a good experience. I got the chance to sort of spearhead my own investment opportunities. I got the chance to, sort of travel the street, go to conferences, meet some really smart people. And what I observed as an analyst there was that, Wall Street is full of really, really smart people, maybe some of them are even geniuses. I don't know. And so what I noticed was a lot of times when they would get stuff wrong, especially on the stock level. So I worked for an equity fund. They weren't getting things wrong because they were stupid, or they weren't getting things wrong because they didn't know their stock well enough, especially on the buy side, right? Sell side has sort of its own conflicts of interest. But on the buy side, when people would get stuff wrong, it wasn't because they were dumb. It wasn't because they didn't know the underlying asset well enough. What I noticed was that it was usually because they were missing the forest for the trees, so to speak. They were missing the bigger picture. They were missing the business cycle. And if you look at back tests and different studies on the impact that the business cycle has on the pricing of individual equities, the business cycle really accounts for about 55 to 80% of the price action in equities. And so if you're ignoring the business cycle, if you're ignoring the growth cycle, the inflation cycle, the policy cycle, you're missing out on an enormous reason that stocks move, right? And so you're going to be confused a lot. And a lot of times people don't think about the business cycle until the wind is at their face, right? They'll think because they're investing in software stocks during a period of loose monetary policy or easy monetary policy that they're just really great stock analysts. And they don't stop to think about the macro environment until all of a sudden policy tightens and their stocks are 70% off of their highs in 6 months.
So here we are, and here we are, and you make the point that fundamentals do matter, and if you couldn't count on the fundamentals mattering, it'd be very difficult to have any sense of what asset class you should be considering taking some risk in. So let's get to the fundamentals. So I know that you believe that we have a deflationary impulse happening right now that is slowing everything down. What do you think the Fed is going to do next week, Michael?
That's a good question. And to be honest, to maybe take a step back, I think we're transitioning from a stagflationary environment into a deflationary environment. And I would say that in both of those regimes, growth is slowing. The difference is obviously that in the deflationary regime, inflation is slowing as well. Now, that doesn't mean negative inflation. I don't think anyone with a brain is expecting negative inflation, in the next few months. But it means something below 9.1% next month and below that the following month. In terms of the impact on policy, I think that, my time horizon tends to be a little bit longer than most of the people on this call. We're usually looking out months and quarters. So if your time horizon is months and quarters, then the impact of policy is not so much in the front months. It's not so much usually about whether the Fed.
There's a lag between what the Fed does and it filtering through the economy, isn't there?
Absolutely. The impact of policy on the real economy happens on a lag, but the bond market, which is how a lot of policy is transmitted, tends to be forward-looking, right? So, obviously on the 9.1% CPI print, you're way above expectations. A lot of people's first reaction would be, all right, tighter policy. And you saw the front of the curve, the front of the Treasury curve move up, but you saw the back of the Treasury curve move down. And why would that happen? Because the bond market knows that the Fed is not going to be able to raise rates forever. And
look at the 10-year right here, Michael. I think this level is very important. It's 272, 274. Hard to get long bonds. I'll use the TLT as a proxy going into the Fed, but they've been acting pretty good. And you're talking about how the interest rate cycle is very important, in that yields are really, the yields and the dollar are really are the main drivers of what's happening to get this deflationary impulse wave, whether it's just a correction in commodities, which I think it has, because if you go back to the 70s, even Volcker thought he had it beat and then had to come back in and really get draconian. And I think in the 70s, there were several times that it looked like inflation was peaking and then it reemerged. Could this just be one of those times and just be a commodity correction?
So I'm admittedly sort of a secular disinflationist. I think that over the long term, a lot of the drivers of disinflation that we've seen since 1980 remain intact. And, with the exception of maybe globalization, right? I think you could make the case that, in a multipolar world, where our supply chains are sort of a national security concern, that globalization has to come in a bit. But when you think about demographics, when you think about debt levels, when you think about wealth stratification, when you think about the ease of credit for anyone that's not a public issuer, all of these things still shout disinflation to me. And if you look at the bond market, right, if you look at 5-year expectations, 10-year expectations, 5-year forwards, they're all saying that we remain in a disinflationary regime. And so, in my view, the fundamental evidence points that way. The market appears to be agreeing with me, at least for now. So I don't think that this is a 1979 situation. Right. Okay. Yeah, exactly. I don't think that there needs to be a Volcker moment. And I don't think the bond market.
No Volcker.
Right. Well, and the bond market is also saying that there's no, if you look at Eurodollar futures, if you look at Fed funds futures, if you look at short-term measures of Treasury curvature, they're all saying that the Fed probably has to cut pretty soon. And the only way that makes sense is recession, right? There's no chance that the Fed is cutting rates with, 7, 8, 9% inflation over the coming months, unless there's a recession.
Okay. And you're talking about, I believe we're going to have a GDP print pretty soon. And to you, it's not just the number, it's a rate of change of GDP. So can you explain that to our viewers?
Right. So if you go back and do the back test, markets generally trade on the year-over-year rate of change most closely. It's a more accurate reflection of the business cycle. I'll say that the headline number that everyone talks about, and I'm sure that this is widely known on this podcast, is a quarter-over-quarter seasonally adjusted annual rate. And there is a ton of accounting noise in how that number is calculated. And so if you run back tests on that quarter-over-quarter number, they're very, very noisy and not terribly helpful. So my suggestion is anyone looking at GDP data is to look at the year-over-year rate of change. And my other suggestion might be, don't spend as much time looking at the GDP data. There are better measures of growth out there. You know, we're big fans of the manufacturing PMIs at Invictus. Find those are more accurate, higher frequency measures of growth with a much closer relationship with tradable assets.
Okay, and on some of the charts that you showed, 103 was a very big area for you for the dollar. Do you see anything on the horizon, perhaps the dollar losing its interest rate edge with what's happening here for there to be? What could possibly cause a peak in the dollar fundamentally?
So according to our work at Invictus, the dollar, and you could say most currencies, really trade on two things: interest rate differentials and policy,
Right.
and then also risk appetite. So you know, what could cause the dollar to go down? I think there's two reasons. One is rates in the U.S. go down, or two, global growth starts to reaccelerate again. I think the latter is very unlikely for right now. I think the bull case for the dollar right now, in our view, is that other central banks become more hawkish relative to the Fed. But we think the most likely outcome is that global growth continues to decelerate quickly. And so there's a flight to safety into the dollar. And so we expect the trending performance of the dollar to be higher. I mean, that's not to say that it can't, dip to 103 again or something like that. But over the next 3 to 6 months, our outlook is still bullish.
Okay. Do you think that with what's happening, especially in the yen, it's really been a parabolic move with the weakness in the yen. Is it possible that there could be some kind of central bank intervention to stop it? I know that Paul has said he wants a strong dollar, but is it possible that the rest of the world doesn't, and there's something like a Plaza Accord deal in the works here for Japan, because Japan couldn't do it on its own? They would need the Fed, and Europeans couldn't do it on their own either. They tightened more than expected yesterday and had a pretty poor response to the 50 basis point hike. Yeah.
So
does that go ahead?
I mean, I'll caveat my answer by saying that Invictus is more U.S. focused, and you're probably more knowledgeable on this than I am. I will say that I think the U.S. Federal Reserve wants a stronger dollar. That's part of how they tighten financial conditions. I think that they're more than happy to export inflation, and I think that right now Japan is more than happy to import inflation. They'd rather import inflation than tighten policy. Their economy is just so anemic for a variety of reasons. Very weak credit system, terrible demographics. That devaluing the yen is not as big a deal for them as it might be for other markets. It's just, hopefully America isn't Japan in 20 years, although I'm kind of biased that way. But yeah, that's our view. I'm inclined to think no intervention will be taking place.
Okay, and I want to go to your take on stocks, because I know that you're, mainly in defensives, right? So I just want to show this chart that, an acquaintance, a friend of mine on Twitter sent to me, and it's the spread between the high risk Russell, low quality compared to, mega caps. And the spread looks like it could be possibly turning. Is that something? I know that's not something you're expecting. If that happened, what's that saying? If small caps begin to outperform the spider?
So, by our investment framework, there are really three macro variables that drive pretty much all liquid asset classes, as well as the different factor exposures and style sectors in the equity market. It's growth, it's inflation, and it's monetary policy, or rather it's the expectations about those things. So the macro variable with the closest relationship to small caps versus large caps is growth. When growth is accelerating, small caps virtually always outperform large caps. And when growth is decelerating, large caps almost always outperform small caps. And so if we were to see the Russell break out relative to the S&P, that would be one piece of evidence that the stock market is discounting faster growth ahead, accelerating growth ahead. I can tell you from, all of the work that we do, all of the bottom-up work that we do, all of the market analysis that we do, we don't expect growth to accelerate again anytime soon. So our expectation is that this sort of consolidation, range trading in the ratio of the Russell to the S&P probably resolves downward, or best case sort of remains range bound. But we don't really expect a breakout. That said, we know what a breakout means if it does happen, right? That would be one bullish piece of evidence.
Okay. Yeah. And like technicians, you probably want confluence of economic indicators along with what's happening in the markets to change your
right. And just what makes logical, right? And just what makes logical sense in terms of historical business cycles, right? You wouldn't expect that when the euro-dollar curve is inverting, that small caps would then outperform. That would be highly inconsistent with historical business cycles.
Okay. And I know you talked about copper, copper being Dr. Copper. You showed most of the economically sensitive commodities under more pressure than things like agricultural commodities. And you made a comment about gold that you're warm to the idea of owning gold, but you just don't see a tactical level that makes sense. Does that mean that you can't find a level where your profit, your risk reward makes sense because you know where you're wrong? When you go into something, what's your risk management on, for example, a position? If you took it in gold, do you use stops, or how do you find that tactical place? And we all have to manage risks no matter what our ideas are. How do you do it, Michael?
So on gold, I think if you're going to have a view on gold, you really have to have a view on real rates. So going back to 2003, I think the relationship between real rates and gold is very close. The R squared is 0.82. The correlation is, I think, 91%. So unless you're just a pure technician, I think you have to have a view on real rates. What drives real rates? Expectations for real growth and policy. And right now, our expectation is that real growth continues to slow. And to be honest, our expectation is that policy, as quantified by the 10-year real rate, probably goes down, right? It becomes easier on the margin. And so that means our outlook for gold is bullish. We'd rather be looking for points to buy rather than points to sell. I think when the video that you saw, it was trading at maybe 1,800, and it was just sort of in the middle of a range.
Okay.
So the upside was maybe to 2,000, but the downside was to 1,700. It's just not an asymmetric setup. We would want to be buying as close to a reasonable support level as possible. Whether we're buying right on support or whether we're buying a failed breakdown. Our outlook is a little bit longer term. So if we have to sacrifice $10 or $15 on the trade because it's not perfect, or it breaks down and it breaks out again, we're less concerned with that.
Anything in the bond market? Yeah, and anything in the bond market that you like here? Sovereigns or anything. It looks like they, both the market and bonds bottomed right around the beginning of the summer, around the solstice. And I wouldn't be short bonds right here. What do you think with your outlook for a weakening GDP, and you talk about the Richmond PMI and all the other PMIs that line up? Most of your charts in that video show the actual moves heading down, and then you extrapolate from that, and they all looked pretty weak and getting weaker. So why not a position in bonds besides a defensive equity portfolio?
I think you got to be long bonds. I think as long as long rates are below their 2018 highs, I think bonds are a very asymmetric bet, particularly relative to equities. When the Fed isn't tightening and growth is slowing, bonds are really the best way to go. So we like bonds a lot here.
Yeah, why can't, even if it's a bear market rally, right, Michael? I mean, halfway back, that's a nice capital gain, but who knows? I know some people that don't think that we've ended that 30, 40-year bull market. Any other area in the market that you want to talk to us, either economically or asset price wise?
Oh boy. So did you see the Philadelphia Federal Reserve survey yesterday for manufacturing?
No.
That was quite a bearish report in my view. And I'm inclined to think it's bearish for the same reason that some people might think that it's bullish. So the two numbers that I thought were most interesting were prices paid and prices received. And we saw really substantial downticks in both of those. And so I think that, and if you go back and do some back tests or correlations, both of those time series tend to correlate pretty closely with CPI inflation or PCE inflation. So the surface level interpretation is that inflationary pressures are easing and supply chains are normalizing. But I think if you think about it a little bit more deeply, I think that's partly true. I think supply chains are normalizing, but I think second order thinking tells you that when you see really quick down moves in pricing like that, it's usually a reflection of demand destruction. And that's exactly what the Fed is looking for, right? And in combination with everything else we're seeing, we're inclined to think that there is a significant element of demand destruction in those declines in price. So anyway, I thought that was interesting and worth calling out.
Are we in a recession, Michael?
I think it's hard to say that we're in a recession while the economy is still adding jobs, technically. I think we're in a growth contraction. I think that, monetary policy happens on a lag. And so I think it's extremely possible we see a recession and that we see a rather rapid increase in unemployment over the next 3 to 6 months. But I don't think it's, formally in a recession yet.
Okay. Well, you know what's in an expansion? My guest list with having a guy like you on to share your knowledge with our community. And I really appreciate your time, and I respect your research and what you've been saying and your demeanor. Best way for people to follow you and follow up on this, should they have an interest seeing you live or the video. Here you go. Here's some free deals. You could go to invictusresearch.com. Is that the website?
Right. It's invictus-research.com. And then I'm also on Twitter at InvictusMacro.
Well, Mike, I'm so glad Tom recommended you to me. It was a great recommendation. You have a unique blend of being an economist, but having a feel and flow for the markets as well. It's usually one or the other. So you have a great blend of both fundamental, and I saw your charts. I want to leave it with the great chart that I saw yesterday was in the crypto. You even covered Bitcoin, and you were talking about how this 18.5 level in Bitcoin is so key because it's it's a prior high from another cycle, and that would end up being like a breakdown to you if we took these levels out. And you showed that Ethereum already did it. Does this week's action, last couple of weeks' action, change the picture in Ethereum? Is it back above that level?
I think it's helpful, before you start taking real economic signal from it, it's helpful to sort of give it some time to settle.
Okay.
I think if it's below that level, that's very bearish for, the underlying assets and also crypto as an asset class. But, if you zoom out and it doesn't break below that level, these are still two of the most bullish charts you can find over the last 10 or 12 years, right? So I don't want to jump the gun.
You believe in the asset class long term?
I think the technicals are telling you to believe in the asset class long term. I mean, not the technicals over the last 6 months, but over the last 5 or 10 years. I do think that there are underlying economic problems that crypto is trying to resolve, namely tight financial conditions for people that aren't public issuers, right? So everyone always talks about how easy financial conditions have been since the great financial crisis.
Yeah.
And that's kind of true if you can issue public debt or maybe public equity. But if you are running a small business or you're poor, you better believe financial conditions are really tight. If you go through the small business, I can't remember the name of the act, but you can go through some government filings to see how much commercial banks have been lending to small businesses. It peaked in 2008, and it didn't get past that 2008 peak until the middle of COVID in 2020. And that was because the government was backstopping all of these small business loans. So banks have been incredibly resistant to lend to small businesses since the great financial crisis.
Yeah.
And the result of that is that good ideas aren't getting funded the way that they used to. And so a lot of the different DeFi projects right now are ways of more efficiently allocating credit. And do I think that's something that the US economy and probably the world needs? Yes. Does that say anything about any specific project or about the near-term price action of Bitcoin or Ethereum? No, it's more of a thematic view. But that's where I see the value.
Okay. Mike, you survived an interview with me. You know what that makes you?
No, what does it make me?
My trading warrior brother.
Oh, I'm honored. I'm honored. Thank you for having me, Dale.
Accept it? Okay, well, I had a good time interviewing you and would love to have you back. Appreciate your giving spirit to share your knowledge. I know it wasn't easy to get proficient like you are nowadays. Took a lot of hard work, right, buddy?
Yes, but there's nothing more interesting than the markets.
Okay, so everyone, Michael Singleton, figuring out the biggest jigsaw puzzle in the world and combining fundamental analysis with also being actionable on asset classes. Thank you, Mike, so much for being with us today. Have a great weekend, a great summer trading season, and let's talk again in the fall.
My pleasure. Thank you for having me, Dale.
Okay. So that's a wrap, everybody. Hope everyone has a great weekend. Remember, don't just count your economic indicators, count your blessings. You could join the team in 15 minutes on the Morning Edge, and I'll see you Monday. I'm determined that the show must go on, COVID or not. You're welcome, guys. All right, President Biden and I we're going to work all weekend and make our plans. All right, have a good weekend. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.